They say you cannot grow small money into something meaningful, that small accounts are destined to stay small. I have seen this lie destroy more traders than any market loss ever could. But here is the truth. A disciplined trader with skill, patience, and a clear method can take a small account and turn it into substantial capital. It begins with understanding one essential principle. Scaling is not luck, it is a process. Every step must be intentional. Every trade must be controlled. Every decision must respect both your system and your capital. Scaling begins with small, manageable trades that build control, experience, and discipline. If you cannot protect $100, you will not protect $1,000. If you cannot handle fear and greed with $500, you will not handle them with $5,000. Small accounts are the training ground. This is where you learn to take losses without panic, take profits without arrogance, and follow your rules even when your instincts scream the opposite. Every small win is a brick. Every disciplined trade builds the foundation. Create this first, and the structure for larger capital becomes stable. The first principle of scaling is risk management. Never risk more than a small percentage of your account on any trade. 1 to 2% is enough. This is not caution, this is survival. Scaling is not about chasing the biggest win today. It is about staying alive tomorrow and compounding consistently. As your account grows, you adjust your position size gradually, always in proportion to your capital and psychological comfort. This is the heart of scaling, increasing exposure without increasing emotional risk. Once small trades are mastered, consistency and compounding become the engine of growth. This is where a small account begins to expand meaningfully. Reinvest a portion of your profits while maintaining your same risk parameters. Do not withdraw everything. Keep enough capital inside to fuel growth. This transforms modest gains into larger capital over time. The key is patience. The market does not rush, and neither should you. Compounding is slow at first, but once discipline takes root, growth accelerates, faster and more reliably than any shortcut ever could. A powerful tool for scaling is the prop firm. Many traders fail to recognize its advantage because they misunderstand the rules. A prop firm gives you access to larger capital while enforcing strict limits on risk and drawdown. But here is what matters. You must first prove you can manage a small account with discipline. Prop firms amplify your profits, but they also amplify your mistakes. You cannot bend the rules over trade or let emotion dictate choices. Only traders who follow their plan with precision benefit from these opportunities. Before pursuing a prop firm, understand your edge. Know your system, your win rate, your average risk-reward, and your trading style. Prop firms are not shortcuts to wealth. They are tools for traders who have already proven their consistency. Start with the smallest allocation. Trade within the limits. Show steady performance. Then increase exposure step by step. Prop firms reward skill, not luck. That is the true advantage. For self-funded accounts, scaling requires gradual growth and diversification. Begin with a small, manageable account and compound profits slowly. As your account reaches a comfortable size, diversify into other instruments or markets using the same rules. This spreads risk while creating more opportunities. Scaling is never gambling. It is controlled, intentional growth. Every step forward must come from skill, consistency, and disciplined risk management. Psychology is equally important. As your account grows, your emotional exposure grows with it. Fear and greed magnify when more money is on the line. The trader who panics at $500 will panic at $5,000. The trader who chases at $500 will chase at $5,000. Scaling must be gradual so your mindset adjusts before your capital increases. Discipline at small levels becomes discipline at higher levels. Each stage is a test. Pass it and you grow. Fail it and losses multiply. The math behind scaling is simple. Risk a small percentage of your account, reinvest profits, and increase position size as capital grows. But math alone is meaningless without discipline. You can have the perfect formula, but if emotion overrides reason, your growth stalls or reverses. The market does not react to desire or ambition. It responds only to skill, patience, and execution. True scaling lies in balancing calculated risk with emotional control. Consider a practical example. You start with $500 and risk 2% per trade. $10. Your strategy wins 60% of trades at a 1-2 risk-reward ratio. Applied consistently, your account begins to grow. When you reach $1,000, you increase your position size proportionally, but stay within your comfort zone. You compound gains, control losses, and repeat. Over time, that $500 doubles, triples, and grows beyond anything that seemed possible at the beginning. This is the power of controlled scaling. Many traders fail at this stage because impatience takes over. They see opportunity and increase their risk too quickly, abandoning the rules that built their account. This is where accounts blow up. Scaling is not about speed, it is about controlled progress. Treat each step as a test. Are you following your rules? Can you handle losses calmly? Can you increase position size responsibly? Only after proving this should you move to the next level. Scaling also requires a long-term mindset. You are not trying to get rich overnight. You are building capital through skill and discipline. Every careful trade, every controlled adjustment, every reinvested profit contributes to the larger goal. By focusing on consistency instead of excitement, by following rules instead of impulses, you create a structure where small capital transforms into significant wealth. This is not theory. This is what successful traders do. Ultimately, scaling from small to large capital is a blend of skill, discipline, patience, and opportunity. Small accounts teach you. Prop firms magnify your gains. Reinvestment compounds your profits. Psychological mastery ensures longevity. A trader who respects these principles can grow modest capital into meaningful wealth, step by step, trade by trade. It is not easy, but it is achievable. And the reward is not just profit. It is mastery over yourself and your process. Once you build discipline in a small account, the next step is increasing trade size strategically without overexposing yourself. Many traders jump too quickly. A streak of wins convinces them they can handle more risk than they realistically can. This is why scaling must be slow and intentional. Increase position size in small increments, always aligned with your capital and emotional capacity. Even if your account doubles, increase size gradually, not all at once. This allows your psychology to adjust without panic. A core principle of scaling is maintaining the same percentage risk per trade as your account grows, usually 1 to 3%. Bigger accounts come with bigger emotional pressure. Consistent percentage-based risk protects you from devastating losses while allowing steady growth. Discipline is everything. No impulsive trades, no chasing, no greed-based risk increases. Reinvesting profits after a winning streak is another pillar of scaling. Avoid withdrawing everything. Instead, reinvest part of your profits back into your account. This controlled compounding accelerates growth without increasing your emotional burden. For example, if you grow $500 to $800, withdraw a small portion for safety, but leave enough capital to keep compounding. Over time, this transforms small gains into meaningful capital. Prop firms remain a powerful scaling tool, but only after proving consistent profitability in a small account. They give you access to capital far beyond what you can personally afford, but they impose strict limits, daily loss caps, maximum drawdowns, and position size rules. Break these and you are out. Traders who follow the rules, stay disciplined, and use a proven system multiply profits far faster than with personal capital. Preparation is the key. Know your edge, document your trades, and practice before entering higher leverage environments. As capital grows, trade selection becomes more important. You cannot treat all setups equally when stakes are higher. Prioritize high probability, high quality setups. Avoid impulsive trades or fear of missing out entries. With larger capital, small mistakes become expensive. Scaling is not about taking more trades. It is about choosing the right ones and executing flawlessly. Tracking performance is essential. Keep a detailed trading journal. Entries, exits, size, logic, and emotional state. Review your results weekly or monthly. Are you overtrading? Are some setups consistently more profitable? Are losses tied to emotional moments? This data allows precise adjustments without increasing risk unnecessarily. Scaling is not guessing. It is structured improvement. Diversification becomes useful once one strategy or market is mastered. Apply your system to similar instruments or additional markets. This spreads risk and opens more opportunities. If you profit from one forex pair or one stock, Expand gradually into related instruments. Diversification must be slow and educated, never jump. Into unfamiliar markets without preparation. Position sizing evolves as your account grows. Use fixed, fractional, or volatility-adjusted sizing to scale intelligently. A $100 position in a $500 account might make sense early on, but as your account grows to $5,000, position size should increase proportionally without excessive leverage. This keeps growth smooth and sustainable. Psychology remains the backbone of scaling. Fear and greed intensify with larger capital. Protecting a big account feels heavy. Growing it feels urgent. Scaling challenges your discipline and patience at every level. Many traders fail not from lack of skill, but because emotion overtakes logic. To scale successfully, treat every trade the same, regardless of size. Maintain the habits that made your small account profitable. Replicating that consistency on a larger scale defines long-term success. Scaling also means learning from mistakes without letting them destroy progress. Even advanced traders lose trades when increasing size. The difference is discipline. Treat losses as lessons, not emotional triggers. Adjust your process, not your rules. Avoid revenge trading, doubling down, or abandoning your system. Every loss managed correctly becomes fuel for improvement. As your account grows, use a balanced withdrawal and reinvestment strategy. When your account reaches a comfortable size, withdraw some profits to reduce psychological pressure, but leave enough to continue compounding. This protects your growth while allowing your capital to scale steadily. Scaling is about controlled exposure, not risking everything on one big move. Remember, scaling is never linear. Growth comes in waves. Some weeks bring steady gains, others pull back progress. This is normal. The key is consistent risk management, intelligent compounding, and disciplined execution. Small, steady steps compound faster than Gian. T leaps. Scaling is a marathon, not a sprint. The trader who understands this turns small beginnings into substantial profitable accounts. Once trading with a larger account feels natural, the challenge becomes managing bigger positions without losing control. Many traders grow their capital but fail psychologically. Scaling at higher levels requires precision, discipline, and controlled execution. Never let your account size influence reckless behavior. Every trade must be deliberate, aligned with your system, and proportional to your capital. At larger capital levels, risk per trade becomes even more critical. Even if your account grows tenfold, your risk should remain within 1 to 2% per trade. Your goal is not explosive wins. It is preservation and steady compounding. Overexposure can erase months of growth in a single careless moment. Strict risk control ensures your profits continue compounding without expanding emotional risk. Advanced compounding becomes powerful with larger accounts. You can reinvest a portion of profits into additional trades while keeping risk percentages steady. After a strong run, allocate slightly more capital to high-probability setups or diversify further. This increases potential gains without adding emotional weight or dangerous leverage. Prop firms remain extremely beneficial at this stage, but only with strict adherence to their rules. With a larger personal account or funded allocation, you gain access to even greater capital, multiplying profits without risking your own funds excessively. Follow every rule precisely. Maximum drawdowns, daily limits, and position size rules exist to protect you from emotional mistakes. The disciplined trader. For a reason, the disciplined trader uses these rules as a framework to grow steadily. Those who break them risk losing both capital and opportunity. Prop firms, when used correctly, become a lever to scale faster while minimizing personal risk. At this stage, trade selection becomes more critical than ever. Focus on high-probability setups with favorable risk-reward ratios. Avoid impulsive trades driven by market noise or emotion. Larger accounts amplify every mistake, so only take trades that align perfectly with your system. Over time, this selective precision produces consistent profits, steady compounding, and sustained growth. Minimize drawdowns. Scaling is not about trading more. It is about trading smarter. Tracking your performance systematically becomes essential at this stage. Maintain a detailed journal of every trade, including entries, exits, position size, and the rationale behind each decision. Review your wins and losses weekly to identify patterns or weaknesses. Are there recurring mistakes? Are certain setups consistently profitable? Are emotional decisions slipping into your process? Successful scaling requires continuous self-monitoring and adaptation while keeping your system intact. Without this feedback loop, even large accounts can stagnate or decline. Psychology remains the foundation of all successful scaling. As capital increases, so does the emotional pressure. Fear of losing larger sums and the greed for faster growth can destroy discipline. The trader who scales successfully approaches each trade with the same mindset used when the account was small, controlled, deliberate, and unemotional. When psychology is mastered, scaling stops being a gamble and becomes a predictable process of growth. Diversification and multiple income streams also play an important role in advanced scaling. Once your core strategy is proven, begin applying it to additional markets or instruments with similar behavior. For example, a trader who succeeds in Forex might expand into commodities or indices using the same methodology. Diversification SPR eads risk, smooths your growth curve, and increases profit potential without fundamentally increasing exposure per trade. Even with large accounts, mistakes are inevitable. The difference lies in how they are handled. Take losses calmly, evaluate them objectively, and adjust where necessary, but never abandon the system that built your account. Revenge trading, chasing losses, or over-leveraging is the fastest path to disaster. Scaling is about compounding success and protecting capital, not seeking dramatic wins. Every loss must become a lesson, not a trigger for emotional decisions. At the highest level of scaling, capital protection becomes just as important as profit generation. A large account is valuable not only for what it earns, but for the flexibility and opportunity it creates. Protect your capital as the foundation of everything you build. Every decision should prioritize sustainability, risk control, and consistent growth. Only by preserving what you have can you continue scaling and take advantage of major opportunities when they appear. The ultimate truth of scaling is that it involves personal growth just as much as financial growth. The trader who transforms a small account into a large one has grown internally as well, in patience, discipline, strategy, and psychological mastery. These qualities compound just as powerfully as profits do. The true reward is not only the number in your trading account, but the confidence, skill, and resilience you develop along the way. To scale successfully, remember these principles: start small, master risk management, and compound profits intelligently. Reinvest earnings, use prop firms wisely, diversify strategically, and maintain discipline at every step. Focus on high-probability setups. Control your emotions. Protect your capital. Every stage of scaling tests both your skill and your psychology. Pass these tests consistently, and small accounts grow into substantial, profitable ones. Scaling is not easy, nor is it guaranteed, but it is absolutely achievable. The market rewards preparation, discipline, and patience far more than ambition alone. Step by step, trade by trade, profit by profit, a small account becomes something meaningful. You do not need luck, you need a method. You do not need shortcuts, you need consistency. The trader who masters themselves, their system, and their risk will turn modest beginnings into true financial success. Remember this final truth: the size of your account is limited only by your skill, discipline, and patience. Control your mind, follow your rules, and the market will reward your preparation. Scaling is a journey, not a race. Each step builds on the last. Each decision compounds your capital and your confidence. Those who stay disciplined, committed, and focused on the process will discover that small accounts can indeed become large, profitable, and deeply transformative, not just financially but personally. Master your capital, master your mind, and scale with intention. Every step forward is earned, every trade a test, and every increase in profit a reflection of your discipline and mastery. The journey from small to large accounts is challenging, but it is also the greatest proof of your growth as a trader. Grow your skills, grow your discipline, grow your account, and the profits will follow. Remember this final truth: the size of your account is limited only by your skill, discipline, and patience. Control your mind, follow your rules, and the market will reward your preparation. Scaling is a journey, not a race. Each step builds upon the last. Each decision compounds your capital and your confidence. Those who stay consistent, disciplined, and focused will see small accounts become large, profitable, and transformative. Master your capital, master your mind, and scale deliberately. Every step forward is earned. Every trade is a test. Every increment in profit reflects your ongoing mastery. The journey from small to large accounts is difficult, but it stands as the ultimate measure of your evolution as a trader. Grow your skills, grow your discipline, grow your account, and profits will follow. If you're ready to take your skills to the next level and challenge yourself, check the link in the description for a recommended prop firm where disciplined traders, like you, can begin scaling with real capital. Don't forget to like this video, share it with fellow traders, and explore our other videos to continue developing your trading mastery. Your journey to scaling bigger profits starts here, step by step, trade by trade, with discipline leading the way.